Welcome to video lectures on IGNOU MBA. We are doing unit number 11, Financial Management and Introduction. In the previous video, we have covered scope of financial management, finance functions, and objectives of the firm. In this video, we are going to cover the remaining topics: risk-return trade-off, conflict of goals between management and owners, financial goals and firm's objectives, organization of finance function, and finance and related disciplines. These are the other topics in this video, in this chapter. We are going to cover all these topics. These are only an introduction topics. Nothing much or nothing deep is given here. We will be just touching upon each topic and what is what. We will be knowing what is what. That's all. Let us jump to the topic: risk-return trade-off. Risk-return trade-off. So basically what it means is that if there is a higher risk, there will be a higher return. If there is a lower risk, there will be a lower return. For example, take government bonds, treasury bills, or high rated corporate bonds. The return on these bonds is guaranteed. If they say 5%, they will definitely give 5%. So there is no default. The return is guaranteed. Means the risk is very, very low. At the same time, return is also very low. Whereas, take for example, small cap equity investment, where the risk is very high. You don't know whether your money will be returned or not. So in such cases, the risk is very high, and sometimes the risk is also, the return is also very high. Though the return is not guaranteed, return will be very high in certain situations. So the management and the investors both should be aware of this risk and return trade-off. These are normally calculated in the financial parlance using the terms like alpha, beta, Sharpe ratio, standard deviation, and other terminologies are also there. We are not delving deep into those topics. We are just giving an introduction. So the management is concerned about how much return they have to generate, and also the investor should be worried about how much return a particular portfolio will get to them. The management has to guarantee a minimum risk-free return. If the government bond is guaranteeing 5% return, then the managers should think of investing in such project that it will guarantee a minimum 5% of return. On top of that, some extra amount of return should be given to the investors because of the risk that they are investing. Otherwise, the investors would have directly gone to the government itself. Instead of coming to this company and investing their money, they would have gone to government and put their money there, because government is anyways guaranteeing 5%. Since the investors investing in your company, the management of this company has to guarantee, or at least try to give some amount of extra return on the risk-free return. That is what is given here. The return is equals to risk-free rate plus risk premium. This risk premium we will study in the next chapters. How this is calculated, how alpha is calculated, how beta is calculated, how Sharpe ratio is calculated. These three are interrelated. Okay, so any decision, whether it is investment decision, liquidity decision, financing decision, or dividend decision, the focus point should be between risk and return. How these two are traded off with each other. Okay. Next, the conflict of goals between management and owners. In a joint stock company means a company which is started by shareholders who put their money into the business, and the business is run by a group of managers who are appointed or selected by the shareholders. Normally, there will not be any conflict between the management and the owners or the so-called shareholders. But sometimes what happens is that the managers tend to pursue their own goals. So in such situations, the main motto of the owners, which is getting more returns or profit maximization, or in other words, wealth maximization, their motto will be defeated if the management pursue a different goal. A different goal means it is given here. It is a firm's objective. Sometimes they may look at market share, their image, welfare of employees, technology, leadership, all these things. If these things are the sole criteria of the management and they ignore the main motto like wealth maximization of the shareholders, then there will be a conflict of goals between management and owners. There should be a balance. A middle ground has to be struck between these two goals. Next, organization of finance function. The finance function is a major functional area. The ultimate responsibility for carrying out the financial management lies with the top management, which includes the chairman or chief executive, managing director, board of directors, and other committees of board. In some countries, different designations are there, like director, vice president, chief financial officer, financial controller. Like the designations may vary, but essentially the task of financial management lies with the top management. Right? Next, finance and related disciplines. The related disciplines to finances are two. Normally, which comes to our mind is accounting and economics. Accounting is simply nothing but collection of information and presenting them in a proper readable format for the higher management to take decisions. The difference between finance and accounting comes in the treatment of funds and at the level of decision making. Accounting normally uses accrual basis of what is that? The measurement of funds in accounting is based on the accrual concept. Accrual concept means though the money is not received, and when the action takes place, suppose a company has sold an item to a vendor or to a customer did not pay the amount to the company, but still in the books of accounts of the company, the sale is deemed to have happened. The transaction has taken place, though the money did not come, it is recorded in the books of the accounts. Whereas in the financing world, this is not registered at all. Since the money did not come, this transaction will not be registered at all. So that is accrual basis and cash basis. Okay. Next, decision making. Decision making is one area where there is a difference between finance and accounting. The primary focus of the function of accountants is collection and presentation of data, while the financial manager's major responsibility relates to financial planning, controlling, and decision making. Thus, the role of finance begins where the accounting ends. Similarly, there is a difference between economics and finance also. Terms and concepts like revenue, marginal cost, which are used in economics, are used in finance world also. Similarly, concepts like working capital, investing decisions are used in economics also. So this is briefly about introduction to financial management. We have covered the scope of financial management, finance functions, risk return trade-off, what are the objectives of the firms, the conflicts. We have just briefed in one line about conflicts between management and owners or shareholders. What are the different objectives of firms? Next, organization of finance function, different concepts used in finance from economics, from accounting, and different concepts of finance used in the other worlds. Like this we have covered. Hope you understood a bit about this topic. See you in the next chapter. Bye bye.